Alright, let's have a little talk. I want you to go find your insurance policies. Your car insurance, your home or renter's insurance, your life insurance. Go ahead, I'll wait. Now hold that stack of papers in your hand. What do you feel? If you're like most people, you feel a little intimidated. It's a thick document, filled with words you don't use every day. It feels heavy, complicated, and honestly, a little boring. So you do what most people do. You sign on the dotted line, you pay your premium every month, and you file it away, hoping you never ever have to look at it again. That, my friends, is a massive financial mistake waiting to happen. That stack of papers is not just a bill, it is one of the most important financial contracts you will ever sign. Think about it. This document is a promise. It's a promise from an insurance company that if disaster strikes, a car crash, a house fire, a serious illness, they will be there to put you back on your feet financially. But here's the catch, that promise is conditional. It is governed by every single word, comma, and clause within those pages. Ignoring what it says is like driving blindfolded. You are trusting that everything will be okay, without actually knowing the rules of the road. You cannot afford to be passive about your own protection. You must be an active participant in your financial security. The truth is, insurance companies are not charities. They are businesses. They have written these contracts to be very, very specific about what they will pay for and what they will not. When you file a claim, they aren't going to look at what your policy covered. They are going to look at what the contract it covers. If there is a gap between your expectation and the reality written in that policy, you are the one who will pay the price, literally. Understanding your policy is not just a good idea, it is a non-negotiable act of self-respect and financial responsibility. You worked hard for what you have. You must work just as hard to protect it. So today, right now, we are going to change that. We are going to demystify this document together. We will turn confusion into clarity and anxiety into empowerment. I will walk you through it step by step, section by section. We are going to translate the legal jargon into plain, simple English that you can understand and act upon. By the time we are done, you will be able to look at your policy not as a source of confusion, but as a tool that you control. This is your money, your future, and your security we're talking about. You have the power to understand it. You just need to decide to use it. Now, let's get started. Every insurance policy, whether it's for your car, your home, or your life, is built on a similar framework. Think of it like a house. It has a foundation, walls, a roof, and rules for living inside. Once you understand this basic structure, you can navigate any policy with confidence. There are 4 main sections you absolutely must know: the declarations, the insuring agreement, the exclusions, and the conditions. These are the pillars of your contract. Everything else is just detail. We are going to look at each one so you know exactly what its purpose is and why it matters so much to your financial well-being. First up is the declarations page, or the DEC page. This is the who, what, where, when, and how much of your policy. It is usually the very first page, and it is a summary of all your specific details. It will list your name and address, the policy number, the effective dates of the coverage, and a description of what is being insured, like your 2024 Honda Civic or your house at 123 Main Street. Most importantly, it lists your coverage limits, which is the maximum amount the insurer will pay, and your deductibles, which is the amount you must pay out of pocket before the insurance kicks in. This page is your policy's personalized snapshot. It must be 100% accurate. Next, we have the insuring agreement. This is the heart of the promise I mentioned earlier. This section contains the broad, sweeping language where the insurance company lays out what it agrees to cover. For auto insurance, it will say something like, "We will pay for direct and accidental loss to your covered auto." For a homeowner's policy, it might say, "We insure for direct physical loss to the property described." This is the core commitment. However, this promise is not unlimited. It is a broad statement that gets narrowed down significantly by the other sections of the policy, which is why you can never stop reading after this part. It sets the stage, but it doesn't tell the whole story. The third section, and one of the most critical, is the exclusions. If the insuring agreement is what the company gives, the exclusions section is what it takes away. This part of the policy lists all the specific events, perils, and circumstances that are not covered. For example, a standard homeowner's policy almost always excludes damage from floods, earthquakes, and neglect. A car insurance policy might exclude using your personal vehicle for a ride-sharing service. Reading this section is not optional. This is where you find the gaps in your coverage, the financial holes you could fall into if you are not paying attention. Understanding what is excluded is just as important as understanding what is included. Finally, you have the conditions. This section is the rulebook for both you and the insurance company. It lays out your duties and responsibilities if you want the policy to remain in effect and if you need to file a claim. For instance, it will state your duty to protect your property from further damage after a loss occurs. It will also detail the steps you must take to file a claim, like notifying the company promptly and cooperating with their investigation. The conditions section also explains the insurer's obligations, such as how they will value and pay for a loss. Violating these conditions can give the insurer a reason to deny your claim, so you must know what is expected of you. Now that we understand the four main sections, let's zoom in on some of the specific language you will find scattered throughout your policy. These are the clauses, the legal terms, that can make or break a claim. They may seem confusing, but their meaning is actually quite simple, once you strip away the jargon. Knowing what these words mean is the difference between being a victim of your policy and being the master of it. We are going to look at four key clauses: subrogation, co-insurance, appraisal, and your duties after a loss. You need to know these, you need to understand them. Your financial security depends on it. Let's start with subrogation. Imagine another driver runs a red light and smashes into your car. Your insurance company pays to fix your car right away, which is great, but it wasn't your fault. The subrogation clause gives your insurance company the right to go after the at-fault driver and their insurance company to get back the money they paid you. In simple terms, it's the right to step into your shoes to recover damages. This is a good thing for you. It helps keep your own insurance premiums down by ensuring the responsible party ultimately pays for the loss. It means your insurer will fight that battle for you. Next is a term that trips up many people, especially in property insurance: co-insurance. This is not the same as your copay for a doctor's visit. A co-insurance clause requires you to insure your property for a certain percentage of its total value, usually 80 or 90%. If you fail to do so, you become a co-insurer and have to share in the cost of a loss. For example, if your home is worth $500,000 and you have an 80% co-insurance clause, you must insure it for at least $400,000. If you only insure it for $300,000 and have a $50,000 loss, the insurer may not pay the full $50,000. They will only pay a portion, and you will be on the hook for the rest. This clause penalizes you for being underinsured. What happens if you and your insurer can't agree on the amount of your loss? This is where the appraisal clause comes in. If you think the fire damage to your home is $100,000, but the adjuster says it's only $60,000, you have a dispute. The appraisal clause provides a process to resolve this without going to court. Typically, you each hire an independent appraiser, and those two appraisers select a neutral third party called an umpire. A decision agreed to by any two of the three is binding. This is a powerful tool to ensure you get a fair settlement, but you have to know it exists in your policy to be able to use it. Finally, every policy has a section outlining your duties after a loss. This is your to-do list when something bad happens, and you cannot ignore it. These duties almost always include giving prompt notice of the loss to the company, protecting the property from further damage, like putting a tarp over a damaged roof, providing a detailed inventory of the damaged property, and cooperating fully with the insurer's investigation. If you fail to perform these duties, you could jeopardize your claim. The insurer could argue that your delay or lack of cooperation made the situation worse, and they could reduce your payout or even deny the claim entirely. Know your duties and perform them. We talked about the exclusions section, but I want to spend more time here because this is where the biggest and most expensive surprises hide. People pay their premiums for years, believing they are fully protected. Then a disaster happens, they file a claim, and they get a denial letter pointing to a single sentence on page 17 of their policy. Do not let that be you. Denial is not just a word, it is a financial catastrophe. Let's look at some of the most common exclusions you will find in standard auto, home, and life insurance policies. These are the big ones you must be aware of. For your auto insurance, a major exclusion is business use. If you have a personal auto policy but start using your car to deliver pizzas, or as a full-time driver for a ride-sharing service, you are likely not covered. Your personal policy is priced for personal driving risk, commuting to work, running errands, going on vacation. Commercial use involves different risks, more mileage, and more time on the road. If you get into an accident while using your car for business, your insurer has the right to deny the claim completely, leaving you personally responsible for all the damages. You must tell your insurer about any business use and get the proper coverage. When it comes to your homeowner's insurance, the two most famous exclusions are floods and earthquakes. Let me say this clearly. A standard homeowner's policy does not cover damage from rising water or earth movement. People who live in areas prone to hurricanes often find this out the hard way. They have wind damage coverage, but the storm surge that floods their first floor is not covered. It is a devastating financial blow. If you live in an area with any risk of flood or earthquake, you must purchase a separate, specific policy for that peril. Other common exclusions include mold, unless caused by a covered peril, sewer backups, and damage from termites or neglect. Life insurance policies are generally more straightforward, but they have critical exclusions too, especially in the first 2 years. This is called the contestability period. During this time, the insurance company has the right to investigate your death, and if they find you made a material misrepresentation on your application, like not disclosing a pre-existing medical condition or a dangerous hobby like skydiving, they can refuse to pay the death benefit. The most significant exclusion is the suicide clause. Most policies will not pay out if the insured dies by suicide within the first 2 years of the policy. After that period, the benefit is typically paid in full. Understanding these exclusions is about managing your risk. It is not about being scared. It is about being smart. When you read the exclusions section of your policy, do not just skim it. Ask yourself, what are the biggest risks to my home, my car, or my life that are not on this list of covered perils? If you identify a gap, like living in a flood zone with no flood insurance, you have found a financial weak spot. Now you can take action to plug that gap, either by buying more insurance or by taking steps to mitigate the risk. This is what it means to be in control of your financial life. A standard insurance policy is like a car that comes off the assembly line. It has all the basic features, but it might not be perfectly suited to your individual needs. This is where endorsements and riders come in. These two words mean essentially the same thing. They are amendments, or add-ons, that change the terms of the original policy. They can be used to add coverage, remove coverage, or clarify existing terms. Think of them as customization packages for your insurance. They are incredibly powerful tools that allow you to tailor your policy to fit your life perfectly, and you need to know how to use them. Endorsements can add coverage for things that are normally excluded. Remember how we just talked about a standard homeowner's policy excluding sewer backups? Well, you can often purchase a water backup and sump pump overflow endorsement. For a relatively small additional premium, this adds coverage for what could be a very messy and expensive problem. Another great example is for your valuables. A standard policy has very low limits for things like jewelry, art, and firearms, often only $1,500. If you have a $10,000 engagement ring, you need a scheduled personal property endorsement or rider to insure it for its full appraised value. These add-ons can also expand the type of coverage you have. On a homeowner's policy, you can often add an endorsement for identity theft protection, which helps cover the costs of restoring your good name and credit if you become a victim of fraud. On a life insurance policy, a popular rider is the waiver of premium. This rider states that if you become totally disabled and are unable to work, the insurance company will waive your premium payments, and your life insurance will remain in force. This is a fantastic safety net that keeps your policy from lapsing when you need it most. It is just as important to understand that endorsements can also be used to restrict coverage, so you must read them carefully. For example, if you have a certain breed of dog that the insurance company considers high risk, they might add a canine liability exclusion endorsement to your homeowner's policy. This means they will not cover any claims related to a dog bite. Sometimes, an insurer might add an endorsement that changes your roof coverage from replacement cost to actual cash value, meaning they will only pay what your old roof was worth, not the full cost of a new one. Always read every endorsement to see if it is giving coverage or taking it away. Before you renew your policy each year, you must review your life and your coverage. Did you get married, buy expensive jewelry, start a home-based business, finish your basement, renovate your kitchen? All of these life events may require you to add an endorsement to your policy to ensure you are properly protected. Call your agent and have a conversation. Ask them, what endorsements are available that I don't currently have? Be proactive. Don't wait for a claim to find out you could have been covered for just a few extra dollars a month. Use riders and endorsements to build a policy that is as unique as you are. Theory is one thing, but practice is another. Let's pull it all together and walk through a simplified example so you can see how these pieces fit together in the real world. We'll use a sample homeowner's policy for a fictional couple, Jack and Jill, who live at 123 Hilltop Way. By looking at their policy, you will see exactly what you should be looking for in your own. So, grab a highlighter, because this is the active part. This is where you learn how to mark up your own policy and make it a document that works for you, not against you. First, we look at their declarations page. It lists Jack and Jill as the named insureds. The policy period is from January 1st, 2026 to January 1st, 2027. Under coverages, we see Coverage A, dwelling, $400,000. Coverage C, personal property, $200,000. Coverage E, personal liability, $500,000. Now the important numbers. Their all-peril deductible is $2,500. This means for most claims, they must pay the first $2,500. They also have a special hurricane deductible of 2%, which is $8,000, 400,000 times 0.02. Jack and Jill must circle that $8,000 number. They need to know that in a hurricane, their out-of-pocket cost is much higher. Next, we flip to the insuring agreement for the dwelling. It says the company covers direct physical loss, but then it specifies it is a named perils policy. This is a critical distinction. It means the policy only covers losses from the perils specifically listed, such as fire, lightning, windstorm, hail, and theft. It does not cover anything and everything unless it is excluded. Jack and Jill should take their highlighter and mark every single covered peril on that list. If it isn't on the list, it isn't covered. This is very different from an all-risk or open perils policy, which covers everything unless it is specifically excluded. Now we turn to the dreaded exclusions section. We see the usual suspects: flood, earthquake, power failure, and neglect. But we also see an exclusion for ordinance or law. This means if their house burns down and a new building code requires them to spend an extra $20,000 on upgraded wiring, the standard policy will not pay for that extra cost. This is a huge potential gap. Jill should write a big note in the margin. Ask agent about ordinance or law endorsement. They also see an exclusion for any business pursuits conducted in the home. Since Jill runs a small online crafting business from the spare bedroom, this is a major red flag. Finally, we look at their endorsements page at the back of the policy. They have one. It's a scheduled personal property endorsement. It lists Jill's engagement ring with an appraised value of $15,000. This is great. It means if the ring is lost or stolen, they can get its full value, and there is likely no deductible for this specific claim. They also see a notice that an absolute roof exclusion for cosmetic damage from hail was added at renewal. This means the insurer will pay to repair a leaky roof, but not to replace shingles that are just dented but still functional. They need to be aware of this limitation before the next hailstorm hits. As you become more comfortable reading your policy, you need to develop an eye for potential trouble spots. Insurance policies are legal documents designed to manage risk, the insurer's risk that is. While most companies are reputable, the language in the contract can create pitfalls that can cost you dearly if you are not careful. These traps are not always obvious. They are often hidden in definitions, limitations, and clauses that seem harmless until you try to file a claim. Let's go over some of the most common red flags you should be actively searching for in your own policies. One of the biggest pitfalls is confusing replacement cost value, or RCV, with actual cash value, or ACV. These terms define how the insurer will pay you for your damaged property. RCV is what you want. It means the company will pay the cost to replace your damaged item with a new similar item without deducting for depreciation. ACV, on the other hand, pays you for what your property was worth the moment before it was damaged. This means they take your 10-year-old roof or 5-year-old television and subtract for age and wear and tear. An ACV policy is cheaper, but the payout can be shockingly low. Make sure your policy provides RCV, especially for your dwelling and major personal property. Another red flag is a policy loaded with high percentage-based deductibles. We saw this in our example with the hurricane deductible. These are common in coastal or storm-prone areas for perils like wind and hail. A 2%, 3%, or even 5% deductible on a $400,000 home means your out-of-pocket cost could be $8,000, $12,000, or even $20,000 before the insurance company pays a single penny. People are often attracted by the lower premium these policies offer, without fully understanding the massive financial risk they are taking on. You must know exactly what your deductible is for every type of peril, and be sure you have that amount saved in an emergency fund. Be very wary of ambiguous or undefined terms. A policy might exclude wear and tear or gradual deterioration, but what does that really mean? One adjuster might see a few worn shingles as wear and tear, while another might see it as storm damage. Look for a definitions section in your policy. The more terms that are clearly defined, the better. If you see vague phrases that could be interpreted in multiple ways, that ambiguity will almost always be interpreted in the insurer's favor, not yours. If a term seems unclear, ask your agent for a written clarification of how the company defines it. Finally, watch out for sneaky anti-concurrent causation language. This is a complex term for a simple, and honestly, often unfair, concept. This clause, often found in property policies, states that if a loss is caused by two perils at the same time, one that is covered and one that is excluded, the entire loss may be excluded. For example, if a hurricane's high winds, a covered peril, damage your roof and then rain, which is only covered if it enters through the new opening, and a storm surge, an excluded peril, flood your home, the insurer might try to use this clause to deny the entire claim. This language is a major red flag and significantly weakens your coverage. I want you to feel empowered to read and understand your own insurance policy. For most people, most of the time, you can do this yourself. However, there are certain situations where trying to go it alone is a foolish risk. Knowing when to raise your hand and ask for help is not a sign of weakness, it is a sign of wisdom. Your financial life is too important to leave to guesswork. Recognizing the limits of your own expertise and calling in a professional is one of the smartest money moves you can make. Let's identify those key moments when you need to pick up the phone and get an expert opinion. The first and most obvious time is before you even buy the policy. This is where a good independent insurance agent is worth their weight in gold. An independent agent doesn't work for just one company. They represent multiple insurers. Their job is to be your advocate. They can shop around for the best combination of coverage and price, explain the differences between policies, and help you identify the endorsements you need for your specific situation. Do not just buy insurance online from a faceless company. Build a relationship with an agent you trust. They are your first line of defense and your personal translator for all that confusing legal language. The second time you need an expert is when you have a complex or high-value situation. Do you own a business? Do you have significant assets and need a large umbrella liability policy? Do you own unique or hard-to-value property, like a historic home or a major art collection? In these cases, a standard off-the-shelf policy is not going to cut it. You may need to consult with a specialized insurance broker, or even a financial planner or attorney who focuses on risk management. They can help you structure a comprehensive protection plan that leaves no gaps. The more you have to lose, the more you need expert advice to protect it. The third, and most critical, time to call for help is after you have suffered a major loss and are having trouble with the claim. If your home is burned down or been destroyed in a tornado, you are in a vulnerable position. You are emotional, displaced, and not an expert in construction costs or insurance law. The insurance company's adjuster works for them, not for you. Their job is to settle the claim for the company. In this situation, you should consider hiring a public adjuster. A public adjuster works only for you, the policyholder. They handle the entire claim process, from documenting the loss to negotiating with the insurer, to ensure you get every penny you are entitled to under your policy. You should also seek legal advice immediately if your claim is denied, or if you are being offered a settlement that seems unfairly low. An insurance attorney can review your policy, the facts of your claim, and the insurer's denial letter. They can tell you if the company is acting in bad faith, an illegal practice where an insurer unfairly denies or delays a legitimate claim. Sometimes, a single letter from an attorney is all it takes to get an insurance company to reverse its decision and pay what they owe. Do not be afraid to stand up for your rights, and do not hesitate to hire a professional to help you fight that battle. We have covered a lot of ground. We've dissected the policy, decoded the jargon, and flagged the pitfalls. But knowledge without action is useless. Information is only powerful when you use it to make your life better and more secure. So, your work is not done. Your real work is just beginning. It is time for you to take everything we have discussed and apply it to your own life and your own insurance policies. You are going to stop being a passive premium payer and become an active, engaged, and empowered policyholder. This is your money, your protection, and your responsibility. Here is your action plan. First, schedule a policy review date with yourself or with your spouse or partner. Put it on the calendar right now. Make it a 1-hour appointment within the next week. When that time comes, turn off the TV, put your phone on silent, and pull out all of your insurance documents. Don't forget your auto, home, or renters, life, and any umbrella or other policies you have. Lay them all out on the kitchen table. Get a set of highlighters in different colors and a pen. You are going to treat this like the important financial meeting that it is. During your review, you will become an insurance detective. With your highlighters, I want you to find and mark the key information on each policy. Use one color for the declarations page. Highlight your coverage limits, your deductibles, especially the percentage-based ones, and the policy period. Use a second color to highlight the insuring agreement to understand the basic promise. Use a third, brighter color, like red or orange, to highlight every single word. In the exclusions section, make notes in the margins. Write down questions. Circle words you don't understand. This is your copy. Make it work for you. Once you have reviewed and annotated your policies, your next step is to take action on what you found. Did you discover a coverage gap, like no sewer backup coverage? Did you realize your jewelry is underinsured? Did you find a red flag, like an actual cash value clause on your roof? Make a list of these items. Then your next call is to your insurance agent. Go down your list with them one by one. Ask your questions. Ask for quotes on endorsements to fill the gaps. Ask them to explain the clauses you found confusing. A good agent will be happy to do this. If they can't or won't, that's a sign you need a new agent. This is not a one-time task. You must make this an annual ritual. Every year, at least 1 month before your policies are set to renew, you must repeat this process. Your life changes. Your needs change. Insurance policies change. A quiet review every year prevents loud, expensive surprises when you have a claim. By taking control, you are not just reading a contract. You are protecting your assets, your family, and your future. You are replacing fear and confusion with strength, clarity, and confidence. You have the power. You have the knowledge. Now go do it. Be the master of your money and the protector of your world.